Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Over the past 2 months, in 4 separate occasions, I've highlighted the significant slowdown in the Indian economy, which is now clearly reflected in the stock prices of major sectors such as passenger cars, consumer goods, banks, financial services, and infrastructure. The two key market indices, Nifty and Sensex, peaked on September 27th and have since shown little momentum until the last couple of days. The sharp two-day rally a day before and a day after the Maharashtra elections was seen as a lucky break for foreign institutional investors to resume their selling. They've been selling quite a lot for the whole of this year. While each such wave of selling will be countered to some extent by buying, the bullish fervor, which we saw last year, is missing. The traditional year-end rally is due, and that's going to happen and probably just underway, especially since the last 2 months have been dismal. But there are more intriguing aspects of the market, which is beyond and hidden behind the Nifty or Sensex moves. Now, here are some numbers. Between 27th September and 29th November, the Nifty was down by 8%. However, amazingly enough, both Nifty and BSE small cap indices were down only 3%, and Nifty microcap dropped by a mere 2%. This is highly unusual. In a bull market, smaller companies typically outperform their larger counterparts, but in a downturn, these usually bear the brunt of the losses. This time, that's not the case. What explains the anomaly? Investors are optimistic about smaller companies for a reason. The heroes of India's growth of the last 4 years have been smaller, efficient companies in green energy, electrical equipment, defense, healthcare services, that is hospitals and diagnostics, a variety of manufacturing sectors, infrastructure, including railways, consumer technologies, retail financial services, including wealth management. There's a large number of sectors where smaller companies are doing extremely well. Apart from this, new sunrise sectors such as electronic manufacturing services, that is outsourced companies, companies doing outsourced manufacturing, recycling, smart metering for power sector, and data centers. These are all dominated by small companies, not large ones. Now, these hot sectors are not represented in the indices in any manner, except partly through one company in Nifty and Sensex, which is Larsen and Toubro, which is very surprisingly should have done very well, but has been a tepid performer. It's not done too well, although it's in most of these sectors, including manufacturing, defense, and infrastructure. The Nifty and Sensex, unfortunately, consist of big banks. They're stable but hardly growing. Consumer companies, not growing. Software companies, very average growth, virtually in single digits. And also commodity companies like Hindalco and so on, some of which are from the public sector as well. All these sectors are not doing well. They're struggling against the headwinds of sluggish demand. They may have cash flows, but that's not what the market is only interested in. It is interested in growth, year-on-year growth, and large growth. Now, why are these not growing? Bank credit is not growing because companies are still focused on deleveraging their balance sheet. There are not many borrowers, while higher interest rate cost is squeezing the margin of banks. Meanwhile, stock market is more than willing to fund any reasonably promising growth story, making equity capital far more attractive to companies, that is borrowers, than bank credit. Consumer sector, consumer companies are grappling with weak demand. That is because of stagnant income growth among the middle class and below. They've been badly battered from the time of demonetization, made worse by COVID and so on. And there's no improvement in the lot. Software companies, they get growth boosters from time to time. And that happens mainly with disruptive cycles such as .com, back office automation, or banking software and finance operations. The last significant cycle was driven by adoption of technology to manage the challenges posed by COVID restrictions on both companies, employees, and consumers. It remains uncertain whether the current artificial intelligence boom will benefit or disrupt Indian software companies. We don't know what. Note that 5-year compounded growth of net profit of industry's biggest player, that is Tata Consultancy Services, was just 8%. 8% compounded annual growth in net profit. That looks like a commodity company. The only bright spot in Nifty and Sensex are pharmaceutical companies, although the fastest growing ones, even in that sector, are outside the main big indices. Now, this gives us a picture of why index stocks are not very exciting place to be for investors. They comprise businesses that are easier to understand, and they have high market liquidity, so you can buy and sell easily. So foreign portfolios are full of them. They like them, but they pale in comparison to smaller companies today, which comes from an array of sectors, which I've mentioned earlier. They form the second and far more dynamic market, which is eclipsed by the headlines made by nifty behemoths. For example, a small engineering company based in Indore with a market capitalization of just 4,000 crore. It exports 65% of its output, so it's globally competitive, has notched up a 54% compound annual growth rate in net profit over the past 5 years. Second example, pharmaceutical company which avoided the beaten track of rushing into the Western markets and instead concentrated on South America has recorded a CAGR in net profit of 42% over 10 years. It's like fantastic performance. India's biggest listed EMS, that is electronic manufacturing company, has recorded a CAGR in profit of 39% in 10 years. Its market cap is now pushing 1 lakh crore. I can give scores of such examples. The contrast between these and the Nifty or Sensex giants is hidden in plain sight. Now, will these companies keep growing? That's a big question. Often it is economic policies of a government that drive corporate growth, and the policy of the past 4 years has been massive government capital spending on infrastructure, defense, railways, etc., and support to local manufacturing through what is called production-linked incentives. These initiatives have had a tremendous impact on small companies. Even a tiny fraction of 11 lakh crore direct government spending on infrastructure, defense, railways, so on, or spending encouraged by the government policies coming the way of some smaller companies, these can propel their businesses into a whole new trajectory. They're too small and the spending and the opportunity is too big. So even a few years of that can just transform them, which is actually what has happened in all of these sectors. Now, when I say sectors, I really mean green energy, electric transformers, smart metering, water management, railway equipment, defense, and so on, which I've all mentioned earlier. Now, small companies, big opportunity, continuous growth. This is the story. However, many other top performing smaller businesses have nothing to do with government policies as well. They come from sunrise sectors such as hospitals, EMS, drug research, manufacturing, consumer technology, outsourced business services, financial services, market infrastructure companies like listed exchanges like BSE, MCX, or something like CDSL, which is a depository. Now, and even some of the older traditional businesses like light engineering, automotive components, they have nothing to do with government spending. They are growing on their own. The top performing companies in these sectors have a tailwind. And the good thing is that they're also run by focused, driven owners, owner-managers in most cases, really hungry for growth. This is the untold story of Indian entrepreneurship. There is an interesting corollary to all this. By a curious set of coincidences, most of the non-promoter shareholding of these small companies is now with retail investors, some of whom have been plainly lucky to be at the right place at the right time, but also a small number of young, very smart investors have done their homework and diligence to catch this trend too over the last 4 years. Now, only a few of these stocks, surprisingly, are in the portfolios of mutual funds, probably because they're too small, so mutual funds can't buy them. This boom, therefore, has bypassed big institutional investors who stayed focused on India's sluggish consumer economy and software stocks and banking stocks. And this probably explains the reason when Nifty falls on FII selling these days, small cap and micro cap indices do not drop that much. This is a phenomenon never seen before. And along with, of course, many other wonders of the Indian stock market that we are witnessing since COVID. If you liked what you've just heard, please share and do subscribe. Thanks for watching.